Markets aren't panicking about the Middle East escalation, but they are rapidly repricing energy risk. This week in market signals, we're looking at why oil, shipping routes and commodities are suddenly back at the centre of the macro story. Now, the conflict involving in Iran has certainly pushed energy markets back into the spotlight, raising questions about inflation, supply chains, and how geopolitical shocks move through financial markets. Now, equity indices remain relatively calm, but beneath the surface, markets are starting to reprice some important risks. Now, the first thing to understand is that energy is still the fastest transmission channel from geopolitics into financial markets. Roughly 20% of the world's oil flows still go through the Strait of Hormuz. So whenever tensions rise in that region, markets immediately begin pricing the risk of disruption. The Strait does not even need to close for prices to move. If we think about insurance costs, they'll start to rise. Shipping routes change. Freight costs increase. And suddenly, oil prices begin to reprice very quickly. And we've seen that over the last week. But something else is happening that investors often underestimate. Now, energy markets today are heavily dependent on global shipping networks. If tankers start rerouting or investors pull back coverage in conflict zones, the insurance there can certainly tighten. So even without physical disruptions, insurance is an issue. So geopolitics increasingly moves through logistics networks and not just energy fields. Shipping, freight, maritime security are now part of the macro transmission mechanism. Energy shocks create a difficult macro scenario. So higher oil prices push inflation higher, but at the same time, they act like a tax on consumers, reducing purchasing power and slowing economic growth. Now, that's an issue for the midterm elections. So the combination of higher inflation and weak growth is exactly what economists describe as stagflation risk. And that's a challenging environment for central banks to manage. There is also a broader structural theme emerging. We know for many years market leadership was dominated by asset-light sectors. So technology, software, digital platforms. But the global economy may be shifting toward something more resource intensive. Now, energy infrastructure, electrification, defence, supply chain resilience, that's all going to require a lot of physical resources, which means commodities and real assets may play a larger role in market leadership once again. So for investors, the lesson is not trying to predict geopolitics, but to question how shocks move through global markets, energy prices, shipping costs, inflation expectations, and sector leadership. These are the channels investors should be watching closely. So markets are not breaking, but they are adjusting to a world where energy security, geopolitics and supply chains are once again central to macro outcomes. And now those shifts are exactly the kind of signals we watch in market signals. Now, I should note the views and opinions expressed in this video are mine, and they do not necessarily represent the views, policies, or positions of Portfolio Construction Forum or its affiliates.